Hi everyone. We are now going to take a look at Chapter 7. And I'm going to break this discussion down into two parts. The first part, we're going to talk about the majority of the chapter. It's actually going to take us up through I believe page 218. Yeah, 218. So from the beginning of the chapter, which is around 200, let's see, 195 to 218. And then I'm going to do the second part of the lecture in a different video. So you're just going to see two out there. So if you're wondering as you're listening to this, hey, she didn't do the whole chapter. I know. I'm going to do part today, which is Wednesday, the, I don't even know what date it is, 25th? Yes. And then do the remaining part on Friday. So you'll see it out there on Friday if you're listening to this before Friday. Okay, so Chapter 7, we're now going to focus on our first security, well, a security, I should say, bond securities. Okay, so we're going to talk all about bonds, and so you really understand what they are. So we're really going to be looking at the first, second, and maybe third point there with this presentation, and then we'll look at the other 2 points there on the second presentation. So we're going to look at bonds and bond valuation, more about bond features, bond ratings, different types of bonds. Second presentation, you're going to be looking more about the bond markets, inflation and interest rates, which you learned about in economics, and determinants of bond yields. So, first of all, what is a bond? Okay, a bond is a promise from a corporation to pay a par value or principal that is stated on the bond. So it's a piece of paper on the bond at a certain maturity date. So the first thing the corporation promises, and I'm focused on corporations here because that's where most bonds come from. So a corporation, just to back up, will say, we need money. And they have some choices. They could sell stock. But what if they don't want to sell stock? Well, they could go to the bank and ask to borrow money. But maybe that's too complicated. Maybe they don't want to go to the bank. It's like Jerry Seinfeld. I don't want to be a pirate, but maybe they just don't want to borrow money from the bank. Well, another option they have is to, and I have my fingers up like quoting, sell bonds or issue bonds. What they're really doing is borrowing from the public. They are borrowing on a loan, just like they would from a bank, but they call it a bond. And it's represented by a legal document called a bond indenture or certificate. We'll talk more about that near the end of the chapter. But when they, quote, sell the bond, the person buying the bond is basically loaning money to the corporation. The corporation promises to pay a principal back. So that's the principal, or what we call par or face value, is planted on that bond certificate at a certain maturity date in the future. Also, over the life of the bond, the corporation promises to pay interest on it at an interest rate. We call it the coupon or contract interest rate. It's stated on the bond certificate, and they calculate it using the principal of the bond. And the maturity date is the date the bond principal or face value is paid back. The yield or yield to maturity is really the market interest rate when the bond is sold. Now, Before we get into calculating this, you need to really understand, and you probably have talked about this with bonds, but just to remind you, the board of directors is usually the part of the corporation that decides they need to raise money and they want to sell bonds. They usually get together, maybe today, which is March 25th, and say, we want to sell bonds. We want to raise money that way. And what they have to decide is, when are they going to sell those bonds? So it's March 25th. Maybe they sell them May 1st. But it's today that they have to decide what kind of principal they could pay back. So how much they want to try to borrow up front the day they sell the bonds, and then what kind of interest rate they should pay on those bonds. And what they try to do is select an interest rate that would probably be the interest rate on other bonds that are similar to theirs the day they sell them. So they're really trying to predict the future. What do we think the interest rate is going to be? Now, between now and May 1st, when we actually sell the bonds, there's lots going on. We have accounting looking to see, is this all feasible? We have the legal department involved because it's a legal document, a bond certificate. There's going to be a lot of little print on it that is talking about the rights of the bondholder and the responsibility of the corporation, just like a loan document would have. So we have these two groups involved. They don't get things done overnight. It takes time. And then we have to have the bond certificates printed. So we might have a month and a half before we actually are able to sell the bonds. Well, during this time period, the market isn't sitting there going, well, we know this corporation wants to sell bonds on May 1st and they want the interest rate to be around 8%. So we'll make sure it's at 8%. No, the market is acting independent of this corporation. So sometimes when that time passes, the company is getting ready to sell that bond. Maybe they have one bond they want to sell. This isn't how it really happens, but let's say they want to sell one bond that has a principal of $100,000. Right, jot that down. The contract interest rate is 8%. So what that means is on the bond certificate that they are going to pay interest at 8% on that $100,000 maybe once a year. You could look at that contract interest rate and the principal as being written in stone. That is the contract. Let me go back here. Remember, they're promising to pay back a principal, $100,000 at the end, maybe in 5 years, let's say. And they're going to pay interest once a year at 8% on that $100,000. That is in stone. It's a contract. We can't white out anything on there because things changed from what we thought. Now, on May 1st, when they sell the bonds, the bondholders, the people that are looking to buy the bonds, are going to go, well, I have $100,000. I could buy this corporation's bond that has an 8% interest rate on it, or, well, what are all the other corporations like this corporation? What are they paying interest at? And that's called the market rate. And let's say the market rate is 8%. So we guessed right. We knew, or we guessed, everybody else would be paying around 8%, and that's what they are. Okay? That's a beautiful moment, because no matter where the person buying the bond, no matter where they buy the bond, they're going to earn the same amount of money on their money. 8%. Okay? Now, when that happens, the bond will sell at what we call the face value. What do we mean by that? It will sell for the $100,000. And we have a special way of calculating what a bond will sell for. And it's using those present value calculations we used back in chapters 5 and chapter 6. That's why we do them. So the selling price of the bond is calculated by taking the present value of the interest that will be paid on the bond over the life of the bond. So in our case, the interest that will be paid, each interest payment is $8,000. 100,000 par times 8% interest. Okay? How do we find the present value of those payments? Well, first we need to know how many payments there are. That will be our number of payments, our N. 5 years, once a year, there'll be 5 payments. So our time periods here are 5. But what interest rate do we use to determine present value? It's always the market rate or that yield rate. So if our market rate is currently 8%, okay, now if our interest payments happen more than once a year, we would have to divide that 8% by the number of interest payments a year. But since it's only once, we will use 8%. So your first calculation, though, is the present value of an ordinary annuity. The bondholder here, or the corporation from their perspective, is going to pay $8,000 every year at the end of the year for 5 years. So we need to determine what is the present value of those. Now I'm going to go into my finance calculator. That's why we suggest you have one. Finance, N is 5, I is 8. We want to calculate for present value. Our PMT is $8,000. $8,000 every year. Future value 0 because we're not worried about that. I'm going to use my arrow keys, go back up to my present value and solve for it. So the present value of those $8,000 payments once a year for the next 5 years is $31,942. I rounded up. So the bond value consists of that. It's basically saying, what is somebody willing to pay today to earn the market rate of return on the $8,000, to receive $8,000 in interest each year for the next 5 years? They're willing to pay $31,942. But that's not the only thing they're buying when they buy a bond. They also buy the right to receive the principal, one payment, the $100,000 at the end of 5 years. So we also need to calculate the present value of that, the present value of that one lump sum future payment. So again, using my calculator, or you could use the formulas, it's present value of 1. You leave your N as 5 and your I as 8, because you use the same exact N and I that you use to calculate the interest present value. My payments are going to be 0 because this is not a calculation with payments. It has a future value of 100,000. 100,000 in the future, what's it worth today? Then I'll go back up and solve for present value, and I get $68,058. Now, if I add the present value of the interest payments to the present value of that future principal payment, the value of the bond is $100,000. So that means the bond will sell for $100,000. But that's not always the case. And we'll test this right now. We're going to keep the same bond. Matter of fact, I think I'm going to end this and I'm going to share my Excel. Okay, let me get an Excel spreadsheet up. Okay, new, and then I'll share it. Okay, so you should see an Excel spreadsheet. Now let's write down our key information here. We have a bond. Its principal is $100,000. Its contract interest rate, or coupon we call it, is 8%. Annual interest, so once a year. And its maturity is in 5 years. Now, the annual interest payment, remember we calculate as principal, 100,000 times contract or coupon interest rate, 8% times time, because it's paid once a year, times 1. So the annual interest payment will be $8,000. So we've calculated all that. What happens to the bond value if the market, or what we called yield, is at 10%? So remember, the first one we looked at, we said, oh, the market, everybody else's bonds on May 1st, remember the sale date is May 1st. So everybody else's bond is also paying 8% interest. But what if instead they're paying 10%? We guessed wrong. We thought it would be 8, actually 10. We can't grab whiteout and white out the 8% on our bond certificate. You can't do that on a contract. We are locked in. We can't change that. Now think about this. You are somebody with $100,000. You can buy a bond that will pay you 10% or $10,000 in interest a year, or you could pay $100,000 and get a bond that pays you 8% or $8,000. Obviously, you're not going to buy the bond that's only paying 8%. You're not going to pay $100,000 anyway for that. And the corporation knows that. Okay. So how can we get you to buy the bond without changing that interest rate? And it's change the selling price of the bond. So you, as the bondholder, want to earn 10% interest. What you're willing to do, though, in order to get 10% interest is buy this bond that's only paying 8%, but you'll pay less for it. So the day it sells, it'll sell for less than how much you'll receive at the end, which would be $100,000. And the corporation knows that. So let's see what would be the selling price of the bond if the market rate is 10% instead of 8%. So the first thing, we're going to use that same formula we just looked at. We need to look at the present value of the par, of the interest, I should say, and add to that the present value of the par value. That will give us the total selling price of the bond. Now, we always use the market rate at the date of the sale to do this calculation. So we take our interest rate of $8,000 and find the present value, assuming the number of payments, the number of interest payments will be 5, and the interest rate isn't going to be 8% now, 10%. And remember, this interest is only being paid once a year, so we'll use the full 10%. Now, we could do this in an Excel formula. Okay, so Let me see, financial, present value. I forget which one formula it is. This is present value of 1. It's okay. Oh. Nope, that's it. So the rate will be 10. Hopefully this will come out. Number of payments, 5. The payment is 8,000. And we're going to look at the type. Whoops. Type. Come on, help me out here. Oh, I don't want to put a comma there. Okay, and the type is logical payment. At the beginning equals 1, at the end is 0. So we'll make sure that's 0 because we want to make sure this calculates for a present value of an ordinary annuity. And I believe I got to make this 0.1. Yes. So you want to put that in as 0.1. So the present value of those interest payments will be $30,326.29. And just like on our finance calculator, it shows as negative because we showed the 8,000 as positive going in. If we want, let's do this. We'll make the 8,000 negative, and then it comes out to be a positive. Now you could do this on your calculator if you have the finance calculator. N is 5, I is 10. Your payment is 8,000. Make sure future value is 0, and then solve for present value, and you'll get the same result. You also need to determine the present value of that 100,000 future payment under the same N and I. So I could use my present value calculation again. Okay, and I'm just going to open it up so I could see the table. I could do this. Rate will be 10. Periods is 5. Payment is 0. Future value is 100,000. And then payment is, type is 0. And hopefully that'll come out. Nope, I did something wrong. Okay, I don't need to add that. This is how we learn, right? There we go. Well, that's really low. And that should be 100,000. I made it 100, 100, 2, 3. Okay, and I'm going to put this 100,000 in as negative so that it comes out as positive. And that is the present value of that one future payment we're going to make. Now on your calculator, just change your payments to 0 and your future value to negative 100,000 and solve for present value, and you'll get the same result. Now add those two together, and that is the selling price of the bond. Now, what does this mean? The corporation is going to receive cash of $92,418.43 for this bond, but they have to pay back the principal at the end of 5 years of $100,000. So that difference, that $7,581.57 that we discounted or took off the principal in order to sell it, this is considered interest. It's a lump sum. So what does this mean? Well, instead of erasing and whiting out our 8%, making it 10%, we lower the price of the bond. We say, give us $92,418.43 today. We only can pay you 8% every year. But at the end, we're going to give you an extra. You only gave us $92,418. We're going to give you $75.81 extra to make up for that interest rate difference. So when the market or yield for bonds that are similar to ours is higher than what our contract rate of interest is, they're going to sell for less. And it's just to make up for that interest rate difference. So that in the end, the people buying our bonds are really going to make over the life of the bond 10% interest. So we have to adjust the selling price. The same thing happens if the opposite occurs. So what if instead the market interest rate is 7%? So now people similar to us, corporations similar to us, they're only offering 7% interest on their bonds. We're paying 8%. Now, we only want to pay 7% because everybody else is paying 7%. So how do we accomplish that? We will actually sell the bonds for more than their principal. Take a look at that. So what will be the selling price of the bond if the market rate or yield is 7% instead of 8%? So we have the same factors here. Our interest is 8,000. Our N is 5. But now our interest is 7%. So I'm going to use my present value. Rate is 0.07. Number of payments is 5. I'm going to put my payment in as minus 8,000. I don't have a future value, and my type is a 0 because the payments happen at the end of the period. I did something wrong again. Let's see. Oh, I just have to put a 0, I guess, at the end here. It just knows that. There we go. That's still not right. What did it do? Changed my 8,000 to an 8. There we go. So the present value of the interest under that yield or market rate would be $32,801.58. We'll do the same thing with the $100,000 par value. N is 5, but now our I will be 7%, just like we used for the interest rate computation. Now, if you're not using Excel, remember you could do this in your calculator. I'll go through that in a second. But our present value will be the 0.07. Payments are 5. The MPER, you use the same as you did for the interest. The payments here there are none, so I'm just going to leave that blank. Future value would be negative 100,000, and I don't have to put a type because there's no payment. It did it again. It keeps changing my, there we go. 100 to 100,000. I guess you do have to put the type at the end there. All right. Now using your calculator, finance app. N is 5, I is 7. First, I'm going to solve for my payment, PMT. I'm going to put 8,000 in there. Matter of fact, I'll make that a negative 8,000. Make sure my future value is at 0 and solve for present value. So the present value of the interest under a yield of 7%, market rate is 7%, is $32,801.58. The only thing I have to change is make my payments 0 and now make future value 100,000 to determine the present value of that one-time future $100,000 payment, the principal. I'm going to solve for present value and I get $71,298.62. Add those two together and the selling price of the bond under this circumstance where the market interest or yield is less than our coupon or contract rate, the bonds sell for more. Why? Take a look at it again. What will the company receive in cash? 104,120. How much do they have to pay back? Principal of $100,000. So they're going to receive 104,120. They have to pay back. I think I have too many zeros there. Yes, 100,000. So they're receiving 4,120 extra. This is prepaid interest from the bondholder. the corporation is going to pay $8,000 when everybody else is paying $7,000. The corporation in the end will only pay out of their pocket $7,000. So the way to achieve this, though, is to get some of the money up front when they sell the bond to the bondholder. So the bondholder actually pays for that interest rate difference by paying more for the bond, because they're going to receive more over the life of the bond than they would anybody else in the market. So they're really making up for that 1% interest rate difference by paying more up front. So that's why they sell more. So we went through a lot of stuff there and probably a whole bunch of slides. But I wanted to show you the actual calculation of determining the bond selling price and what happens under these different circumstances when the bond coupon rate, or contract we call it, is different than the market. So I'm going to stop sharing my Excel and go back to PowerPoint. Keep moving along. Oh, there we go. Well, that's not what I wanted. I have a different PowerPoint. There it is. Okay. So that's what the rest of our slide is talking about. As interest rates increase, present values decrease. So as your market or yield rate goes up, the present value will decrease. You'll pay, it'll sell for less. And as interest rates increase in the market, okay, as interest rates decrease in the market, meaning the market will be less than contract, bond prices increase. So they have an opposite effect on one another. So here is what we just did. Consider a bond with a coupon rate of 10%, and the payments, the interest payments, the annual coupons are once a year. The par value or principal is $1,000 and the bond matures in 5 years. The yield to maturity, which is also called the market interest rate, is 11%. That's how much the bondholder wants to make over the life of the bond. What is the value of the bond? How much will that bond sell for? Now they use our actual formulas. Present value of an annuity would be the amount of interest, the payment, which is the bond principal, $1,000 times the bond coupon rate of 10%, $100, times 1 minus 1 over 1 plus the yield or market interest rate to the number of interest payments. Divide that by the market or yield. Then add to that the present value of the lump sum, the future principal, $1,000 divided by 1 plus the market rate to the number of interest payments power, 5. And we showed you how to utilize that in your calculator. So you can do that in your calculator, Excel, or using these formulas. You know these formulas already from chapters 5 and 6. We're just showing you how to utilize them to determine bond selling price. So this bond would sell for $963.04. That interest rate difference of 1% would cause these bonds to sell at almost $37 less than their principal. Then we see the other side, what I showed you in the Excel. What if instead they mature, the yield to maturity, the yield market rate is 8%. And now these are 20-year to maturity bonds. The interest is still paid once a year. Well, we would take the actual principal payment that would occur, the interest payment that would occur at the end of each year, $1,000 face value times 10% contract rate, $100. Using the formula times 1 minus 1 over and divide by 1 plus the market or yield interest rate of 8% to the number of interest payments power, 20. 20-year bond, once a year. And then divide that by your yield interest rate. Add to that the second result, the $1,000 principal payment divided by 1 plus the market rate or yield to the number of interest payments power. That will give you the present value of that one future payment, the $1,000. The first computation gives you the present value of the interest payments, assuming it's an 8% yield or market rate. So the bonds in this case would sell for $1,196.36. Again, you can put all this information in your calculator. Now, take a look at what they say down there using the calculator, and I want to show you this trick now. When I was showing you the computations, I said first determine the present value of the interest payment, then determine the present value of the principal payment. But you can do this in one step. Just make sure you put your numbers in correctly. So for instance, for this one, you could put in your calculator N is 20, I is 8. Put your payment in there, $100. Also, put the future value in there, $1,000. Let me see if it screws up when I do this. Then go up, make sure your PMT is on N, by the way, and then solve for present value. And it'll give you your answer. So you can do this in one step. You could put your PMT, your interest payment in the PMT, and the future value that you're going to get in the future value, and solve for both in one number. So just a shortcut. Now, I know this is hard to see, but here's your graphical relationship between the price and yield to maturity. So when you're looking at a 10-year bond, has an 8% coupon rate. Notice 8%. So if the market or yield to maturity is 8%, what will the bond price be at? $1,000. And we proved that before. In our example, we had a $100,000 bond for 8%. Now, if you don't believe me, put it in your calculator. N is 10, I is 8%. Your market rate is 8% also. Your present value you need to calculate, your PMT, 8%, which is your coupon rate also on $1,000 is $80. And then your future value is $1,000. Now go up and solve for present value. It is $1,000 because your market or yield to maturity and your coupon are the same exact rate. So it will sell for par. But as your interest rate decreases, so if the yield or market decreases, goes to the left, watch what happens to the price of the bond. It increases. And the opposite occurs if the yield or market increases from your coupon rate. That's where we're increasing it from. So if the market rate increases percentage-wise, the price of the bond decreases. Yeah, we discount it to get people to buy it. And that naturally happens. So that's something you need to know and keep in mind. And that's how and why it's affected. So if your yield to maturity equals coupon, then the par value is the selling price. But if yield to maturity, the market, is greater than the coupon rate, then the par value will be greater than the selling price. Yes, the discount provides the yield above the coupon rate. We talked about that already. So when it's priced below par, it's called a discount bond. It's sold for a discount to make up for that interest rate difference. If the market or yield to maturity is less than the coupon rate, then the par value will be less than the selling price. Why? Because the higher coupon rate causes value above par. we're demanding that bondholder prepay us some of that interest rate difference. And we say that we're selling it, it's a premium bond. Now, if you just want one formula to do the calculation, there it is. It's the C, or the interest payment, times that formula, 1 minus 1 over 1 plus R, which would be market or yield to maturity, to the T power. T is the number of interest payments over the life of the bond, So if you have 2 interest payments a year for 20 years, that would be 40. You divide that by your market interest rate. Now, if interest is paid more than once a year, you would need to divide that annual market interest rate, or what we call yield to maturity, by the number of interest payments, and that's your interest for this calculation. Add to that the future value, which would be the bond principal, divided by 1 plus the market interest rate, the same one you used for R, to the Tth power, the same one you used over in the other formula. Add those two results together. The first result will be the present value of an ordinary annuity on your interest. The second is the present value of your principal. So, if an ordinary bond has a coupon rate of 14%, then the owner will get a total of $140 per year if the bond is a $1,000 bond. And this is from example 7.1 in your book. I should go to that. Let me see if I can find it quick. It's on page, this is example 7.1. Yeah, on page 199. So let's take a look. In practice, bonds issued in the United States usually make coupon payments twice a year, not once a year. So our first example said, well, once a year. So if an ordinary bond has a coupon rate of 14%, the total interest for a year would be $140. But that would be split into 2 payments a year, or $70 each. Bond yields are quoted like annual percentage ratings. So the quoted rate is equal to the actual rate per period multiplied by the number of periods. So in this example, with a 16% quoted yield and semi-annual payment, the true yield is 8% for 6 months. So, how do we calculate the selling price or the bond value? Well, this is what I was just talking about. When we're calculating the present value of this bond, we will calculate the present value of the actual interest payment, $70. So it'll be $70 is our payment. What interest rate do we use? We use the market or yield divided by the number of interest payments a year. 16% divided by 2. So we're determining an interest rate for the interest period of 6 months. Since there'll be 2 interest payments a year, and this bond is for, let me see, I guess 7 years, there'll be a total of 14 of these payments. So we raise it to the 14th power. So your N in your calculator would be 14, your I would be 8, 0.08 I mean, or 8, I'm sorry, it would be 8. And then you divide that by that 0.08 in our formula. You add to that the future value of 1,000, which is your principal, divided by, again, 1 point, whatever you use for that first calculation for interest is what you use for this second, 0.08 to the 14th power. In our calculator, I'm back to my apps, N is the number of interest payments, 14. I is the rate that the market is at for our interest period. Well, if it's 16% for a whole year, we need to know what it is for 6 months. That would be 8. Our PMT would be the $70 interest payment, and our future value is 1,000. And we'll go back up and solve for present value, and you get 917.56. So we want to show you that when you have more than one interest payment a year, you have to adjust the interest rate you use and the number of interest payments. Now, interest rate risks. Okay. And this is on page 200. And this is the risk that arises for bondholders when interest rates fluctuate. So, how much interest rate risk a bond has depends on how sensitive its price is to interest rate changes. And this is determined based on 2 things: how long it takes the bond to mature and the coupon rate of interest. So we're saying a change in price due to changes in interest rate is a price risk. Okay, so there's even more risk involved. Long-term bonds, so ones that will be out there for longer terms than short-term bonds, have more of a price risk. Why? Because they're out there so long, and interest rates can change so much. Price change due to interest rates. So a price risk change will be on bonds that are out there longer. Low coupon rate bonds have more price risk than high coupon rate bonds. Why? Because of the market rate changing. If the coupon rate is much higher than the market rate, then the change in the market, not a big deal, not as much price risk. But if your coupon rate is low and that market rate is changing, then there's more price risk, or the risk that the price will change. And that's always because of interest rates. Reinvestment rate risk. What is this? It's uncertainty concerning rates at which cash flows can be reinvested. So short-term bonds tend to have more reinvestment rate risk than long-term bonds because we know what they're going to make over the long haul. High coupon rate bonds have more reinvestment rate risk than low coupon rate bonds. Again, you are earning a lot of money with a high coupon rate bond than you are with a low coupon rate bond. Now remember what reinvestment rate risk is. The risk that you take that you're not going to be able to invest your money at the same interest rate. So if it's high coupon rate, there's a lot more risk that you probably won't be able to reinvest that money in the same type of high coupon rate. But that risk is lower because when the coupon rate is low right now, the chances of you being able to reinvest at that or a higher rate are much greater. So they're inversely related. And there is a graph showing that. So we want to make sure you understand the different types of risks associated with bonds and interest rates. So in this case, our first bond there is in the green line. It shows us that if this bond is a 10% bond for different interest rates and maturity. Okay, so if we have a 10% coupon rate bond, if it's for 30 years, and the market or yield to maturity is 5%, that bond will sell for $1768.62 because of the 30 years. If the interest rate is at 10%, of course, it'll sell at $1,000, its face. If it's for 15% interest rate, it'll sell for $671.70, and then 20%, $502.11. Now, what if it was a 1-year maturity, very short term? You could see the calculation of how it would sell under the different yield or market interest rates. Now, remember what we said. Let's go back. Price risk. Long-term bonds have more price risk than short-term bonds. Yep. Look at how those prices change as the interest rate changes. These bond prices stay very close together. That $1,000, same bond, just changing the term of it. Look how much more risk is associated with that, with the price changing. Whoops, I wanted to go back here. Low coupon rate bonds have more price risks than high coupon rate bonds, but we're not comparing those here. Short-term bonds have more reinvestment rate risk than long-term bonds. Okay, and that's true too, because take a look. If you say you bought this bond at when the interest rate was 15%, you're only paying $671.70. Okay, so you could probably reinvest that money, you know, you will be able to. I'm trying to think of my thought process here. Go back one more time. I got to look at it again. Short-term bonds have more reinvestment rate risk than long-term bonds. Okay. No, that's not what I wanted to go with. Now, this is just showing us really how the bond values will differ due to the time to maturity. So I think I've accomplished what I wanted to. That's all that's really telling us. So yield to maturity, again, is the rate implied by the current bond price. Now, what will happen in the actual bond market is prices adjust to what the market is willing to buy and sell. And it's usually based on what similar bonds are offering as a coupon rate. Sometimes we have to find that based on what the bonds are selling at. So we can use our financial calculator, and it's usually a lot of times with trial and error due to we're calculating two different present values, and that's all that's saying. Consider a bond with a 10% annual coupon rate. Okay, so using your financial calculator or Excel is the best way to go with this. What if we know the bond is selling, well, we know the number of interest payments are 15. The bond's present value, what it's selling at, is $928.09. We've been calculating the $928.09, but what if we know that? The payment, the annual interest payment is $100, so we're going to put 100 in. And the future value is 1,000. That's how much the principal is. What is the actual yield on this bond? What is the market rate of interest to force this bond to be sold at $928.09? We'll solve for interest, and you'll get 11%. So we could determine that. What is the yield to maturity on this bond by looking at its current selling price and these other variables. What if instead the coupon rate is 10% and they're semi-annual, has a face value of 1,000, 20 years to maturity, and is selling for $1197.93? Well, now be careful. Your N will be 20 years times 2 interest payments a year, or 40. Your present value you'll put in as your negative, what it's selling at, 1197.93. Your payment is 50. because it is a $1,000 face value, 10% times 6/12. Interest is twice a year, so one interest payment would be 50, and the face value or future value is still at 1,000. Now you can go up and alpha enter to solve for interest, and you get 4%. But that 4% is for 6 months because the interest happens twice a year. So you need to multiply that result by 2. So that means the current yield to maturity or market value is at 8%. And that makes sense because our bond is paying 10% and we sold it for more than its par value. So the market or yield to maturity must be lower. So again, here is the table that is in our book on page, just defining all these little, bottom of page 202, defining all the variables to do our calculation for the bond value. So you could use this formula, you could use your calculator, you could use Excel. You can determine present value for the interest separate and then the principal separate and then add them together. Current yield versus yield to maturity. So the current yield on a bond is your annual coupon rate, so how much you receive in interest annually, divided by how much you paid for the bond. Okay, so that is how much in actual return you are receiving. Yield to maturity is your current yield plus what we call the capital gains yield. Now, let's take you to that. Okay, and that would be on, let's do the first one first, and then we'll talk about the capital gains yield. So here's our example, 10% coupon bonds, semi-annual coupon, so they pay interest twice a year, face value is 1,000, 20 years to maturity. The bond sells for $11.9793. Current yield would be, and that is the annual interest. So you might say, well, I thought interest was 50. Well, that's for 6 months. We want to know 12 months of interest. So it would be $100 divided by what we paid for the bond today, $11.9793. So our current yield on the bond is 8.35%. Yield to maturity is your current yield plus what we call your capital gains yield. Capital gains is really a term we use in taxes. Bonds are what we call a capital asset. Okay, it's a capital asset in the eyes of tax law. When you sell a bond for more than you originally bought it at, you have a gain. So we call it a capital gain. The other thing could happen too. You could sell it for less, and that's a capital loss. But we're focused on capital gain yield here. So we want to know, if we sold this bond in 1 year, how much would we sell it for? And let's assume we would sell it for $11.9368. Oh, this is a negative. Excellent. So we would sell it for less than we originally bought it at. So capital gain yield is the amount you would sell it for, the future amount you would sell it for, $11.9368, minus what you paid for it, $11.9793. So that would be your gain or loss. In this case, it would sell at a loss. You would receive less than you originally bought it for, or a negative $4.25. Divide that by the original purchase price. So 4.25 divided by 1197.93. Your capital gains yield would be 0.35%, but that would be a negative. So let's take our current yield of 8.35%. Since we would take a loss if we sold this in 1 year, subtract the capital gains yield, 0.35. So our yield to maturity, 8%. And that's the same yield to maturity as computed earlier. Now there's different theorems out there related to bond pricing. Bonds of similar risk and maturity will price to yield about the same return, regardless of the coupon rate. And that's what we're talking about, the market rate. If you know the price of one bond, you can estimate its yield to maturity and use that to find the price of a second bond. This is a useful concept not only with bonds, but other assets as well. And let me see one thing here. See if I wanted to bring out anything else there. So that's something to keep in mind. We're going to look at more theorems related to that. There's a specific formula for finding bond prices on a spreadsheet. Hey, I didn't know that. So in Excel, we can do this. I use the present value function, but there's a price function where you would use settlement, maturity, rate, yield, redemption, frequency, and basis. Let's take a look at it. I'm actually going to click on it. I'm going to make sure you can see it. I'm going to stop sharing the PowerPoint and go back out and share this. Let me close that and make sure I could see this. Okay, make it active. Just bear with me. Share that. There it is. Okay. So you should see my PowerPoint. So you are looking at a bond that is 25 years to maturity. The coupon rate is 9%. Coupons are paid semi-annually. The yield to maturity market, is 8%. What is the current price? Well, our rate is 4%. Remember, that's your yield to maturity market divided by 2, since interest is paid twice a year. The MPER is the number of payments, would be 25-year bond, twice a year payment for interest. It's really your total number of interest payments. The PMT is your par value of your bond. I guess it's a $100, or we're assuming it's a $100 bond. Coupon rate, 9%, and then make sure you times that by 6/12. It would be a $4.50 each interest payment. The future value would be 100. So yeah, they use the PV here to determine the present value. You could also use the price function. Oh, okay, I see, the settlement date. So the settlement date is the date it was sold. The maturity date would be, of course, the date it matures. So Excel will automatically calculate that for you. So those are always our first two items. Settlement date, and they refer to B3, in case we change that. Maturity date would be the next item in this formula, or B4, the 315. Then we put the coupon rate, which in our item is 9%, and we put it in there at an annual percentage in this formula. Then we would put the market or yield to maturity at its annual rate. We would put the face value of the bond and the number of times per year the interest is paid. So Excel, knowing these variables, will calculate your price of your bond. I just took a different approach like they did over here. Now, if you want to find the yield on the bond, you could use the yield function. And it looks like in this case, again, we would list the settlement date. B3 is your first variable in this formula. Then B4, which is your maturity date. Then the annual coupon rate. Then the bond price, because in this case, we want to determine what's our yield to maturity. So we would know our bond price, then the face value of the bond, and the number of coupon or interest payments a year. Inserting those items into this formula will calculate our yield on our market interest rate. Pretty cool. So you can utilize Excel to complete these. All right, I'm going to go back over to my PowerPoint, share that, finish this up. Okay, so what's our major differences between debt and equity sales? Well, debt, you are not an owner, you are a creditor. You don't get to vote as a creditor, but you do get interest, and interest is considered, for a corporation, interest is considered a cost of doing business and is tax deductible. Creditors, though, have a legal recourse if interest or principal payments are missed. So corporation is obligated legally to pay those. Excess debt can lead to financial distress and bankruptcy. Equity does represent ownership interest. Common stockholders vote for the board of directors and other issues. Dividends are not considered a cost of doing business, so are not tax deductible. However, dividends are not a liability like interest is, and stockholders have no legal recourse if dividends are not paid. So you don't have to pay a dividend as a corporation. An all-equity firm can go bankrupt merely due to debt, since it cannot go bankrupt merely due to debt, since it has no debt. So just the major differences between selling debt versus equity, which this chapter we focused on debt with the bonds. So let's finish up our discussion talking about some characteristics and types of bonds. The first is the bond indenture. That's our contract. That's our bond certificate. I keep referring to it as. This tells the basic terms of the bond, the total amount of bonds issued, the description of the property, if any, if there's collateral on the bond, sinking fund provisions. We're going to talk more about those. Call provisions we'll talk more about, and details of protective covenants. So these are any kind of rules or regulations on the corporation and how much more debt they could acquire, things like that. Bonds are either registered or bearer. Registered are the corporation keeps track of the owners, the most current owners of the bonds, and anytime the bonds transfer ownership. Bearer bonds, the corporation sells essentially a coupon book, and whoever holds that coupon book is the owner of the bond. So they don't physically track all the names of the owners. In order to get interest payments, whoever owns the coupon book would take the coupon out of the book, take it to the bank, and get the interest payment. Some bonds are secured with collateral. So it could be secured by financial securities. A mortgage bond is secured by real estate of the corporation. So the corporation doesn't pay. If you have a mortgage bond of the corporation, you could take a piece of their real estate. If you have some other collateral, it could be some other asset. Debenture bonds do not have any collateral on them. That means if the corporation doesn't pay you, you lose the money, or you would get whatever there is in bankruptcy, if any. Some notes are unsecured debt with original maturity less than 10 years. Okay. Seniority. Let's get into that. So, just want to make sure I don't miss any of the things that they're talking about here. Make sure you understand them all. These are all on page Seniority, page 209. Okay, so we looked at collateral. So seniority. Seniority indicates preferences to positions over other lenders. So some debt is subordinated, as in, for example, a subordinated debenture. So what does this mean? In the event of default, meaning the corporation doesn't pay the holders of subordinated debt, I'm sorry, in the event of default, the corporation doesn't pay off the bonds, holders of subordinated debt must give preference to other specified creditors. So this means subordinated lenders will be paid off only after others have been paid. So that's just another way a bond could be classified. Okay, so the coupon rate depends on the risk characteristic of the bond when issued. Which bonds will have higher coupon, all else equal? Secured debt versus a debenture. Okay, so a bond, and this is also on page 209. I'm looking here. I thought it was in this area. Hold on with me there. Just going to put you on pause a second. Won't even know I'm gone. Okay, so which is has a higher coupon? Well, the debenture bond will have a higher coupon rate than the secured debt because debentures have higher risk with being paid back. Subordinated debenture versus senior debt. Well, subordinated because they have more risk will have a higher coupon. A bond sinking fund versus one without. Well, what is that? A bond sinking fund, and this is, they don't have a specific side on this, I don't know why, but it's on the bottom of page 209. It's just an account, words we use to describe the saving by the corporation. So it's like a savings account the corporation has where they put money aside to pay off the bond principal when it matures. And they do this over the life of the bond. So they give you some of the specifics in the book about this bond sinking fund, but that's all it is. So which will have more risk? A bond that has the corporation's required to save for the future payment of it, or one without? Well, the one without would have more risk, so it will have a higher coupon rate. A callable bond versus a non-callable bond. Again, what is a callable bond? And this is over on page 210. So a callable provision means the company's allowed to repurchase or call the bond at some price over a specific period of time. So corporate bonds are usually callable. Okay, and they usually call them more than their par value. So this would be right on the stocks or the bond certificate if a bond is callable or not. And it just means they can mature it before the actual maturity date. Well, a callable bond will have less risk than a non-callable bond. So the coupon rate would be higher on that type of bond. So the more risk, the higher the coupon rate. Now, the final area we're going to talk about today are bond ratings. Now, think about it. You have $100,000 and this corporation wants you to buy their bond that has no collateral on it. Are you going to buy that bond? Well, there's companies out there that rate bond investments by how well the company will probably pay you back. So there's Moody's and the S&P. Moody's has a rating system. They use A's, B's, C's. So does S&P. It's just different looking. So a AAA from S&P is that them telling you this corporate bond, it's extremely strong that you will get your payment back at the end. If it's AA, it's strong. So those are high grade bonds. Medium grade, capacity to pay is strong, but more susceptible to changes in circumstances. Now you're at an A. And then it goes from there. Then you could see the Bs, and then it goes down even into Cs. So as the bonds are lower grade, the less likely that you may receive your principal and or interest payments on them. Now, these types of bonds tend to have very high coupon rates when they're very low grade, because who wants to buy that bond and take that risk? So they start going into this grade called junk bonds. So a Moody's C and below and an S&P C and below, very low grade, meaning income from the bonds with no interest being paid or in default with principal and interest in arrears. That's where those bonds are at now. So it's like a credit score for corporate bonds, whether you'll get your money or not. And they even do it for the government. Speaking of, the government issues bonds too, just not corporations. So sometimes the federal government will issue treasury bills, we call them. So treasury bills are what we call pure discount bonds with original maturity of 1 year or less. Treasury notes are coupon debt with a original maturity between 1 and 10 years. So take 1 to 10 years. And then treasury bonds are coupon debt with original maturity greater than 10 years. So remember, when we say coupon, they're not keeping track of everybody. Everything's done through coupon books. Okay, and you could read more about those on page 213. Municipalities also offer bonds. So just so you're familiar with those. Okay, so that ends the first part of our discussion, and really it's the meat of chapter 7. We'll come back on our second part and talk more about bond markets, interest rates, and bond yields to wrap up chapter 7's discussion. So please post any questions you may have to the discussion board.